The December Purchasing Managers Index fell by 2.2 index points to 49.4, below the key 50 mark. Abdul Davids, Head of Research at Kagiso Asset Management, joins us now to unpack the numbers. Thanks so much, Abdul, for joining us today. Well, we had Standard Bank this morning saying that it expected PMI numbers to stay above that 50 mark, along with a few others. I'm sure they're very disappointed with the numbers that have filtered through this afternoon, falling below 50 in December to 49.4. Were you surprised by the kind of data that filtered through?
We were mildly surprised. I think the extent of the drop at 2.2 index points, as you pointed out, was a bit surprising, albeit that we know that the November number, one of the numbers that we look at is the PMI leading indicator, which is the ratio of new sales orders to inventories. That already was below the key 1 index level in November, pointing to a weaker December number as well.
Taking a look at some of the factors that came to bear, I mean, let's go through it, because one that people possibly overlook is the fact that you've had a stronger currency to contend with over the period, and that means that it could have spelled prospects for higher import demand, impacting our local manufacturers in a pretty big way.
That could be the case. That could be one of the contributors. Clearly, we've seen the rand weakening significantly from about August, September last year, and going beyond the R8.30 level. It strengthened somewhat over the last couple of months, November, December as well. But I think one of the other key indicators and key drivers of the December number is just the level of activity. That declined quite significantly as well. And we know that, for example, our motor manufacturing sector was impacted quite significantly in December. And one of the contributors there was the lack of import components. I think one of the issues there was the Thai floods that we saw in the middle of last year, that impacting motor manufacturers across the world. And South Africa, I think, were particularly impacted by that as well.
Surely no big surprises coming through there, that the fact that we had business activity declining because it was the festive and the holiday season, Abdul.
Although we do adjust for that in terms of the seasonality adjustment. So clearly with the year-on-year numbers being seasonally adjusted as well, I think we do cater for that. But having said that, I think if one looks at especially the new sales orders, level of business activity, that declined. And it could be an indicator that maybe factories and manufacturing businesses shut down earlier in December this year compared to previous periods as well.
What does that spell for the pricing index moving forward? Because so far it's gained 1.2 points to reach 83.3, and it shows the elevated producer inflation rate that these producers face right now. It hasn't filtered through entirely to CPI just yet, and that's reflective of the diminished purchasing power that's out there, the strain that the consumer is possibly under, despite the strong retail numbers that have filtered through. Abdul, what does this spell for the outlook on that index from here on out in your books?
Yeah. Unfortunately, the outlook is not that great, given the fact that the rand, as you pointed out earlier, remains stubbornly above the key R8 level. We have seen a significant weakness in the rand over the last 6 months. Even if you look at the rolling averages, 12-month average this year is about R7.30 on a 12-month basis. So the spot rand is still significantly weaker than the 12-month average, suggesting that price levels will still be elevated from current levels. We also know that the oil price, for example, being a key input in our manufacturing sector as well, has stubbornly been above the $100 a barrel mark as well. So indicating that that component of input prices will stay at elevated levels.
You touched on that inventory index number a little earlier and purchasing commitments. I mean, we had in November that index rising, suggesting that purchasing managers expected demand to be somewhat stronger than it turned out to be. To what extent do we extrapolate this time round that a lesson has been learned here? Because in contrast, this time round, that inventory index has declined to 50.9.
Yeah. Bearing in mind that the way to read the inventory index is actually a decline is positive, because it shows that performance is reasonably good. And by reducing inventories, it actually means that actual throughput in the manufacturing sector is picking up as well. However, one needs to read that in conjunction with the new sales orders and also the expected business conditions index. Now, the anomaly that we've picked up in this month's data is the fact that the expected business conditions index have actually rose, and it rose by about 6 index points as well. However, in contrast to the leading indicator still pointing to probably a weaker January PMI number as well. So I think what is happening is that coincidentally, the inventory numbers are weaker, and it shows that right now we're working away at some of the excess inventories as well. But looking forward, we are potentially seeing some weakness coming through in manufacturing production in January and potentially February as well.
Of course, these month-on-month numbers are very volatile, Abdul, when you look at things on a month-on-month basis. So let's look at a trend here, because we seem to have recovered from that 2008-2009 recession period, but we've been stagnating over the past year or so. So what's your outlook? Because many out there saying that they see this a sector that's going to struggle to gain momentum from here on out unless we see private investment activity pick up, unless we see employment levels pick up as well.
That's right, and unfortunately our fortunes are very much tied to what is happening in Europe and the US to a lesser extent, and also China as well. If one looks at Europe being about 35% of our exports, it is our key trading partner. All of the Eurozone PMIs for December were weaker, below the 50 level, although some of them did strengthen. They average between 46 to 48, the December readings. So again, indicating that Europe is still going through some tough times. The manufacturing and the economies are still contracting. And obviously we do know about the sovereign debt issues around the Eurozone as well. So unfortunately, given that that is our major trading partner, that will continue to impact on our local indices and our manufacturing sector as well. Coupled with that is the fact that the Rand, from a competitive point of view, clearly with the Rand weakness, we should expect some pickup in terms of manufacturing for exports, but a lot of that is already in the base. So unfortunately, the outlook from here is tied to what is happening in the global arena. We've seen some of the Chinese PMI numbers, although it picked up in December, still remaining below the key 50 level as well. So a globally weaker economy will unfortunately negative impact on our manufacturing sector as well.